Welcome back to the LeverUp AMA series. I'm Marcus, and today we're digging into a metric that shows up on every trading terminal, gets referenced in every liquidation post-mortem, and yet most traders I talk to can't actually explain how to use it. That metric is open interest. Joining me is James from the LeverUp team. James, glad to have you.
Thanks for having me, Marcus. This is one of my favorite topics because it's genuinely useful once it clicks, and I think a lot of traders are closer to getting it than they realize.
Let's find out. Let's start from zero. Section 1, what open interest actually measures. So, open interest. Everyone sees it on the charts. Define it for me like I'm not sure I've ever really understood it.
Open interest is the total value of all positions in a market that are currently open, not yet closed, not yet liquidated. If you look at any perp exchange right now and you see $800 million in open interest, that means there are $800 million worth of leveraged positions sitting open at this moment.
Okay, and here's where I want to slow down because I've seen people count it wrong. If I open a $100 K long position, does that add $100 K to OI or $200 K because someone on the other side took the short?
It adds 100K, that's the key nuance. Every open position has two sides, a long and a short, but OI counts the size of the position once, not twice. When a new long and a new short match up, OI increases by the notional value of that trade. One new pair, one increment. If you close that position, OI drops by 100K. The number you see is the total notional of all active positions outstanding at a point in time.
So it's a stock of open bets, not a flow of trading activity.
Exactly, and that distinction matters a lot when you're trying to use it as a signal, which we'll get into.
What is it actually denominated in? Like, is it a count of contracts or a dollar figure?
Most venues report it in USD or the quote currency, a notional dollar value. So $500 million OI doesn't mean 500 million positions. It means the sum of all those positions' notional value is $500 million. $1 whale holding a $200 M position contributes more to that number than 1,000 retail traders with $200 K combined. Section 2, why OI matters more in perp markets.
Walk me through why OI is supposedly more informative in perps than in, say, traditional dated futures. Because I've heard this claim, but I've never heard the mechanism explained well.
Two reasons. The first is settlement. In dated futures, the kind that expire, open interest naturally compresses towards zero as expiry approaches. All those contracts have to settle, OI goes to zero on expiry day. So when you're looking at OI in a dated futures market, you're always working against a clock. The data is noisy because people are rolling positions, not necessarily expressing a new view.
Right, and in perps there's no expiry.
No expiry, OI can accumulate for months. A trader who went long in March and is still holding in July is still in the OI count in July. That means you can see long-term conviction building in the data, or you can see the weight of old positions becoming a structural risk. Neither of those things is visible in a dated futures market the same way.
What's the second reason?
Funding rates. In perp markets, the mechanism that keeps the price anchored to spot is funding. Longs pay shorts or shorts pay longs depending on which side is dominant. And OI imbalance is what drives that. If the market is 70% long by OI, the funding rate turns positive and longs pay shorts. The bigger the imbalance, the higher the cost. So OI isn't just a passive count, it directly creates a trading cost signal. Reading OI alongside funding tells you both how crowded the market is and exactly how much it's costing to stay in that position.
So you can look at OI alone and know if the market is leaning one way. But you need funding to know if that lean is expensive.
That's a clean way to put it. High OI with high funding on one side, you know the trade is crowded and it's costing the dominant side to hold. That combination is one of the clearest warning flags in perp markets. Section 3, reading OI alongside price.
Let's get practical. I've seen the four-quadrant framework, OI up down, price up down. Explain it because I think people pattern match on it without understanding why.
Sure, so starting with rising price and rising OI, that's the clearest bullish signal. New capital is entering the market. People are opening fresh long positions and pushing price up. The move has conviction behind it because it's driven by new participants, not existing ones closing trades.
What flips that signal?
Rising price with falling OI, that's short covering. Price goes up not because new longs are entering, but because shorts are getting out, closing their positions, which buys price back. It can look identical on a price chart, but the underlying dynamic is completely different. Short covering exhausts itself once the shorts are closed. New long entry can sustain a move. That's why the OI data changes how skeptical you should be about the rally.
And the bearish side?
Falling price with rising OI is the clean bearish signal. New shorts are actively entering and pressing the trade down. That has the same conviction logic as the bullish case, just in the opposite direction. Falling price with falling OI is more ambiguous. It typically means long positions are being closed, either from profit-taking or liquidation. The selling pressure is coming from exits, not fresh short entry. That often signals a trend that's running out of steam rather than accelerating.
So the key filter is the move being driven by new capital entering or by existing capital leaving?
That's exactly it. New capital entering creates momentum that can sustain. Existing capital leaving creates a price move that runs until the exits are done. And if you're looking only at price, you can't tell the difference. Section 4, open interest and liquidation cascades.
Here's the part that I think really matters in crypto specifically, the relationship between OI and liquidation cascades. Because we've seen these events play out. Walk me through the mechanism.
So when you have a large buildup of leveraged longs, high OI, skewed heavily toward one side, you have what I'd call concentrated liquidation fuel. Each of those long positions has a liquidation price. If spot drops to that level, the position gets force closed. The forced close adds sell pressure to the market. That pushes price lower. Lower price hits more liquidation levels. More forced closes, more selling. And this repeats until either price stabilizes or the OI is cleaned out.
And the bigger the OI, the bigger the potential cascade.
Proportionally, yes. A market with $2 billion in long OI and heavy funding costs is a fundamentally different risk environment than one with $400 million in balanced long-short OI, even if spot price is identical. The first market has a lot more that can go wrong in a fast move.
This sounds like OI is almost a leading indicator for those events.
It can be, if you're watching OI data in the days before a sharp drawdown, you often see the build-up clearly. The cascade doesn't come from nowhere, it comes from concentrated positioning. And concentrated positioning shows up in OI before it shows up in price. That's part of why traders who watch OI closely sometimes see the risk building before the price chart shows anything unusual.
So not a perfect crystal ball, but real information about structural fragility.
Structural fragility is a good phrase for it. It doesn't tell you when the drop happens, but it tells you that the setup for a fast, amplified drop exists. Section 5, open interest versus volume.
Let me ask about a confusion I hear all the time, OI versus volume. They sound related. They're reported next to each other on most dashboards. What's the actual difference?
Volume is a flow. It measures how much was traded during a time period, total buy and sell activity over an hour, a day, whatever window you're looking at. It resets. When the day closes, yesterday's volume is history. Open interest is a stock. It's what's accumulated and still sitting open at a specific moment. It doesn't reset. It goes up when positions open, down when they close, and the balance carries forward continuously.
Give me an example where they diverge and tell different stories.
High volume with falling oil, that means a lot of trading activity, but positions are being closed as fast as they're opened, maybe even faster. Active market, but not building a structural position. Someone could be day trading enormous size, generating huge volume without leaving any lasting open interest. Now compare to high volume with rising oil. Same high activity level, but now the market is accumulating. Positions are opening and staying open. That tends to be more significant for multi-day price direction, because you now have a cohort of traders with active exposure that has to be resolved at some point.
So volume tells you how busy the market is. OI tells you whether that activity is sticking.
That's exactly it. Busy and accumulating is a different setup than busy and churning. Hash section 6, how LeverUp handles OI, the cubic funding model.
Let's bring this back to LeverUp specifically. You have a different approach to managing open interest and the funding rates that come from it. Walk me through what you've built.
So most perp protocols use a linear relationship between OI imbalance and funding rate. The more longs dominate, the linearly higher the funding cost. That model has a problem. Even moderate imbalances generate meaningful funding costs that grind on traders holding positions across multiple funding periods. LeverUp uses a cubic OI funding model. The cubic formula is nonlinear. At low to moderate imbalances, the funding rate stays much lower than a linear model would produce. But at severe imbalances, the response kicks in hard. The protocol's ability to correct extreme skew is preserved, but traders holding positions in a balanced or moderately skewed market pay significantly less.
Why does that matter practically? Spell it out for someone holding a position over a week.
If you're holding a long position over several days and the market is moderately long skewed, not extreme, just somewhat crowded, a linear model charges you funding that compounds across periods. After a week, that funding drag is real money. Under a cubic model, moderate imbalance generates much lower funding. The position is cheaper to hold. OI can grow in that market without creating persistent headwinds for the side that happens to be dominant in a balanced to moderate way.
So it's more forgiving of normal market conditions, but still aggressive when the imbalance gets dangerous.
That's the design intent. Normal conditions, traders can hold positions without the funding mechanism working against them significantly. Severe imbalance, the model responds proportionally to bring the market back toward balance. It's not soft on risk, it's better calibrated to where risk actually exists. Hash close.
All right, let's land this. What are the 3 things you'd want every trader to take away from this conversation?
First, OI is a stock of open positions, not a count of traders or a sum of both sides. When you see a $500 MOI figure, that's the total notional of active positions at that moment, each pair counted once. Second, pair OI with price direction before drawing any conclusions. Rising OI with rising price means new capital is entering. That has conviction. Rising price with falling OI is short covering, a weaker signal. The mechanism behind the price move matters, not just the direction. Third, high one-sided OI is structural fragility. It's not a guarantee of a cascade, but it's the precondition. If you're in a market with massive long OI and climbing funding costs, you're in a market that's sensitive to a fast move down. That's worth knowing before the move happens, not after.
And on LeverUp, the cubic funding model means that building OI in a balanced market doesn't cost you the same as in a crowded one.
Correct. The funding cost you pay is calibrated to how dangerous the actual imbalance is, not just to how much open interest exists in absolute terms.
James, thanks for breaking this down. For listeners who want to go deeper, the full article on open interest is linked in the description. It's got the full price versus OI matrix, the liquidation cascade mechanics, and links to the liquidation and funding rate deep dives. Check it out. I'll see you in the next one.
Thanks, Marcus. Go read the OI data before your next trade.